Hi, I'm Sandy Ray, founder of Sandra E. Ray CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, I want to talk to you about how donor restrictions impact your funding. There's an old saying that our organization is cash rich, but operations poor. And what that means is we've got plenty of money, but it's all restricted. And that's because well-intentioned donors support our specific programs and events and leave us without any dollars for our operational activities. And really, that's on us. We need to be communicating to our donors the real cost of our programs, including our overhead. So I want to talk to you today about doing just that. We're under such pressure to put every dollar towards programs and keeping our supportive services expenditures under a specific percentage. And this is great for donors who want to give their funds to efficient operating organizations who are fiscally responsible. But I have to tell you, when we're looking at 990s, especially for smaller organizations and cash basis entities, those percentages are really not comparable from entity to entity, because there are some entities who are doing a great job of allocating overhead to those various programs and departments. There are some who do a little bit of allocation, and there's some who do none at all. So we're talking about, when I talk about supportive services, obviously, is our fundraising department and our administrative in general. And most of us do a wonderful job of making sure that all those direct costs go into the proper program or department. But there's a lot of inconsistency in how we're allocating those overhead costs. I'm talking about things like rent and other occupancy costs, information technology, communications, human resources department. Those are the kinds of things that we're spending our money on that benefit not only our supportive services, but our programs as well. And we're not allocating those costs to every area that it supports. So I want to talk to you about how to do that. And before we do that, I want to say, yes, there are going to be some things that are just so small. We're going to leave it in administrative in general, because that's generally where we put most of this stuff when we're not allocating it. And we can, if it's so small, it's not worth the cost. Or if we come up with a system that's so elaborate and so expensive to implement, we don't want to do that either. So the timing of these allocations could come into play. Do you want to do it with every transaction? Do you want to do it once a month, once a quarter, once a year, just for the 990? That's up to you. But I recommend at least by the end of the year that you get these allocations posted into your general ledger system. And I want you to make it simple. If it's something related to direct costs of compensation, use direct payroll, a percentage from each department or each program, allocate maybe the human resources expenses to those areas based upon direct payroll. If you don't want to use direct payroll, maybe time is a better way to do that. And it can be budgeted time or actual time. If your staff is filling out timesheets, you can use actual time. We can do a 2-week time study every quarter. There's all kinds of things that we can do with time. Another allocation statistic is number of units. This is great for like technology and phones, because we can count the number of phones or the number of laptops or the number of devices in each program and each supportive service department. And then we can come up with a percentage and allocate the expenses related to those devices among all of the overhead or among all of the programs. And then finally, things like rent or occupancy costs. Use square footage. And honestly, I don't even use square footage. I go into people's offices and I count ceiling tiles, because ceiling tiles are consistent in shape and size. And that will give me pretty much the same percentages as if I had gone in and measured everybody's offices very carefully. So I love that little hack. Count the ceiling tiles. Well, once we have our allocation method and we've been able to allocate those overhead expenses to our programs and our departments, we can come up with some pretty standardized percentages that we can use, especially if we're watching this over time. For example, we all know that for every dollar of wages, we're going to have at least an additional 10% of expense for payroll taxes and 10 to 20% for employee benefits based upon your benefit package. So those are some standardized percentages that we can use when we're looking at dollars. So if we know these people are going to be in this program and we're allocating them to that grant, we can add 10 to 30% for taxes and benefits. Also, for every dollar of wages that's spent on a program, we could come up with an occupancy cost percentage, an IT percentage. So you see where I'm going. We come up with these percentages based on our history of how we're spending it, how it's getting allocated. And then we have some pretty standardized percentages that we can use when we're working on our grant applications. And we can put those in our grant applications in our budget. Now, some proposals are going to want that shown separately, and that's perfectly fine. I want there to be complete transparency in this because we don't want the grantor or the donor to come back and say, no, we do not include that overhead, or no, we do not include benefits, or no, we don't include this. Put everything in there, get it out in the open, discuss it before you sign the document, because you really don't want to deal with the consequences afterwards. And honestly, there are some grantors who are not going to cover the overhead costs. Many government grants, especially cost reimbursement grants, are not going to do that. So it gives, these percentages also tell us, okay, we've got the direct costs covered. This is the amount of money that we need to raise from other sources so that we have our operations covered. And I want to talk to you about those other sources. Now, obviously, the first area is our unrestricted contributions. We want to continually be cultivating those unrestricted donations. That's the best source of operational money. There's generally smaller dollars involved, but there's way more donors involved than a single grant. So I recommend that you make it very simple for donors to donate. Always remember to say thank you. And I always recommend that you give the donors an idea of what you've been able to accomplish, either through an annual report or your year-end appeal letter, whatever. This is what we did this year. This makes the donor feel really good about your program service accomplishments and turns them into loyal donors. Will they donate year after year? Another source of revenue is program fees. Now, program fees never cover generally even the direct costs of the program. Maybe they do, maybe they don't. Or maybe they're on a sliding scale based upon the constituent's income. Now, we have program fees as a way to get the constituents to buy into the program. So they're invested in the program. They do have some money invested in the program. But again, that's just to barely cover the cost of the program, but it will help us in addition to our restricted funds. So the tongue membership fees. If we have a membership organization, maybe we have membership fees, and those need to be sure to be more than the cost of providing the membership. So like if you have the newsletter or whatever other types of benefits you're giving members, make sure that the membership fee covers the expense of those. So we're covering that plus our overhead. Sales. Do you have a store, a virtual store, or a brick and mortar store? We can sell related items or memorabilia as nonprofits. If you have a museum and you want to sell works of art or things that people in your program have created and you're selling those, that's all wonderful. The net income help cover the overhead of the organization. Just make sure that you check on your sales tax regulations in your state and if you're selling online in multiple states, because we want to make sure that that's covered. Another source of income may be rental of space, either virtual or physical, or advertising income. Again, this is going to be covering expenses that you're already going to incur anyway, and so this is just additional money to help cover those costs. The only caveat I have for here is make sure you do your due diligence on unrelated business income tax. Now, unrelated business income tax, as we've discussed before, is based on the net income. So you have to have a net income in order to have to report and pay taxes. And so that tax is just another piece of the cost of doing that. Anything over and above all those costs are going back into the organization. Another source of income is sponsorship. Now, this is different than advertising because there's some limitations on what you can put, like no promotional information in a sponsorship. Somebody wants to sponsor an event or a website, we can put a banner up and say sponsored by, and their name and their logo and a little bit more information, but there cannot be any promotional information, like come to our website and buy our product kind of thing. One item that used to be very popular for additional sales income is royalties. It's still available to you, but most organizations are not comfortable anymore selling their mailing list. So that doesn't happen too much anymore. And then the last area I want to talk about is investment income. That's where we're taking money, we're putting it aside, we're putting it in an investment portfolio. Maybe that investment portfolio is just certificates of deposit or a savings account, but we're putting money aside. If we're actually investing in the stock market or using a broker, you want to make sure that you have an investment policy that's been developed by your investment committee or your executive committee so that you communicate to that investment manager exactly what your risk tolerance is, what you will accept and what you will not accept. And then for investment income, it's just a matter of being patient, making sure that you're giving it time for that income to come in. And part of investment income, I want to talk about an endowment fund. Now, this is a really long-term strategy where we're asking our donors to give us additional funds. This is in addition to their unrestricted contributions to help build this endowment fund that will provide income in perpetuity for the organization. So we want to be very clear about our endowment goal. What do we want our corpus to be? Is it $100,000 we're going to raise and then we can start pulling income off of it? Is it $5 million? Be very clear about your goal. Once you've reached your goal, be very clear from the beginning. How are the earnings to be used? Is some of it supposed to be retained in the corpus, or is all of it allowed to be used in our operations or for a specific program? Be clear about how the investment management fees are to be paid. Is it coming from the endowment fund itself, out of the income, or is it coming from operations or a combination? And then finally, sometimes there's another wrinkle when fair market value losses occur. How are those going to be, quote, funded? Does that come from the endowment income or operations or a combination of the two? So to recap, remember to include overhead in grant applications, not just the direct costs, whenever possible. And work towards a well-diversified revenue stream that includes not only your restricted donations and grants, but unrestricted contributions, program service fees, membership revenues, sponsorships, rents, advertising, royalties, and investment income. I hope this was helpful, and I want to thank you for joining me today. Remember that creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.